An inverted yield curve shows that long-term interest rates are less than short-term interest rates. With an inverted yield curve, the yield decreases the further away the maturity date. The market is still inverted, and at the end of 2023, the 3-month yield was 5% versus the 10-year at 3.25%. Future expectation of interest rates have reversed and ended 2023 at levels seen at the beginning of the year, erasing 12 months of interest rate hikes. On December the 13th, the U.S. Federal Reserve released its Fed dot plot, which showed a projected 2.5% cut by year-end 2026. The median Fed dot plot showed potential rate cuts of 75 basis points for 2024. Regardless of the pace of cuts, the old slogan states, "Don't fight the Fed." Therefore, we strongly suggest that investors who avoided bonds due to challenging conditions over the last few years start reallocating capital. Specifically, investors should allocate some of their equity exposure towards investment-grade corporate debt. My name is Curt Cumming, and as usual, I'm joined by Currie, head of our fixed income investment team and portfolio manager of the Goodwood Milford Fund and Goodwood Segregated Institutional and Private Client Accounts. Chris has invested in the fixed income market for over 30 years, including portfolio management positions at OMERS, TAL Asset Management, and as a corporate bond credit analyst at CIBC World Markets. Chris, looking back at 2023, what worked and what surprised you?
2023 was a volatile year for bonds. Returns were mixed in the first half of 2023 as the market digested 3 25 basis point rate hikes from the Bank of Canada and 4 25 basis point rate hikes from the US FOMC. Final rate hikes for 23 for both the Bank of Canada and the FOMC occurred in July, with the Bank of Canada at a level of 5% and the FOMC in a target range of 5.25 to 5.5. July marked the start of a 3-month bond sell-off prompted by a rise in headline inflation and strong job creation numbers in the US. Year-to-date returns for the FTSE Bond Index as of the end of October were negative 1.1%. In November and December, we saw a rally in bond prices due to falling inflation data, several FOMC governors speaking that rates had risen high enough, and a move by the US Treasury to pull back on sales of longer-dated Treasury bonds. Bond market's bullishness was confirmed at the December 13 FOMC press conference, when Chairman Powell stated that he felt that the FOMC had reached a peak in rates.
The first week of 2024 saw a more cautious reassessment of rate cut prospects following the U.S. employment numbers, resulting in a rebound in yields. Then, in the second week of January, U.S. inflation data exceeded investors' expectations and challenged predictions of an imminent interest rate hike by the Federal Reserve. The Consumer Price Index increased by 3.4% in the year through December, the highest in 3 months. Despite the uptick in inflation, it remains within the range that hasn't significantly harmed the labor market, leading to expectations that the Fed will still lower borrowing costs this year. However, Fed officials have pushed back against market expectations on an interest rate cut as early as March. Chris, what key economic indicators do you use to manage interest rate risk in your portfolios?
I agree that CPI is currently one of the most important economic indicators. The direction of inflation and the monthly rate of change or pace of inflation are 2 factors driving interest rate moves. As you know, monetary policymakers set interest rate policy to either reduce inflation or, for example, in the case of Japan, to stimulate inflation. We use economic data releases to create a forecast of the future rate of inflation. Key economic indicators on the demand side that could provide insight into future inflation include employment and job creation levels, GDP, and income growth and wage settlements. Supply factors include the level of fiscal spending, tax policies, raw materials and input prices, and tariffs and trade policies.
Comparing a pendulum to the bond market is an interesting analogy. Just as a pendulum swings back and forth in regular predictable patterns, the bond market often experiences cyclical movements. Changes in interest rates, economic conditions, and investor sentiment can drive these market cycles. All 3 forces impacted the bond market movements in Q4, causing the bond market to swing too far towards lower interest rates. As with all pendulums, the market will oscillate and return to equilibrium. Analyst consensus anticipates modestly lower returns in equities and stable returns in fixed income over their forecast horizon. With prospects of lower interest rates, many bond investors are extending duration exposure to generate equity-like returns. However, we believe corporate bonds can achieve equity-like returns in 24 without significantly increasing exposure to long-term interest rates, subjecting the portfolio to large pendulum swings. Chris, what is your return expectations for 2024?
Well, Curt, to start, we must be aware that 2024 is an election year, the US election year, which has implications, especially in the summer and fall leading up to the election. Before we discuss that, let's look at our forecast for Canada for 24. Our forecast is for the Bank of Canada to start cutting rates in March. This would move the front end of the curve down by approximately the size of the cut. We are forecasting 4 cuts in Canada, 25 basis point increments. We would need approximately 200 basis points for the curve to normalize and stop being inverted, which we are not forecasting. In the US, we forecast a first interest rate cut in April with a 50-50 chance in March. The election plays a part here as we believe the Fed moves in September up to the election would be off limits as they would be seen as politically influencing the outcome of the election. The Fed is forecasting 3 25 basis point rate cuts. With September off limits and no August meeting, cuts could be expected at the June and July meetings as well. We think the bond markets will rally once the Fed starts its cutting cycle. The soft landing forecast, easier availability of money is bullish for corporate outlooks, and investment-grade corporates should do well.
Analysts, economists, and academics pontificate on whether the economy will have a hard, a soft, or a no landing scenario. Regardless, you often emphasize the lower risk profile of investment-grade bonds compared to equities and lower-rated bonds. Can you comment on credit quality and stability, especially during market volatility caused by economic shocks?
Volatility of bond returns is lower than equities as a result of the coupon income that acts as an offset to downward price movements. The coupon income that is paid semi-annually gives fixed income its reputation for stability. Saying this another way, the coupon income will be the base return, then we will add or subtract capital gains or losses from price movements. So you can see that bonds have a higher starting return than equities, which gives them a higher degree of stability. In reference to credit quality in a period of economic volatility, investors will naturally gravitate towards the safest returns. A contractual interest payment, such as from an investment-grade corporate or government bond, represents a relatively safe and secure source of semi-annual cash flow. The graph you're looking at shows the volatility relationship between long bonds and short-term bonds over the past 5 years. Investors need to be mindful of volatility. With the inverted yield curve, we remain very interested in clipping 5% plus coupons at the short end while extending duration in the new issues market. There are many companies currently issuing 10-year plus bonds with attractive coupons.
Using historical data, Chris, and returning to hard and soft landing scenarios, how have investment-grade bonds performed during these economic cycles?
The performance of investment-grade bonds does vary under the 2 scenarios that you referred to, Curt. In a hard landing, we would expect that investors would seek the highest rated bonds, typically treasuries or provincials. This is partly due to government entities not being as sensitive to economically related impacts. Plus, these entities have the ability to fund their debts through tax payments. Corporates in a hard landing would not be as well off. We would expect earnings would be negatively impacted. In a soft landing scenario, by definition, the economy is not as severely impacted. In a soft landing, we would expect that investors would view investment-grade corporate bonds as attractive investments. The extra coupon that investment-grade bonds generate over treasuries would be seen as positive in our view.
Goodwood works with advisors, foundations, pensions, and third-party investment fund companies to manage their investment assets and meet their financial goals. To that end, we manage growth mandates through our equity portfolios and income mandates through our fixed income funds and segregated accounts. Our fixed income mandates can be tailored to meet specific investment needs like income generation or capital preservation. We manage 3 fixed income mandates for institutions and individuals: an investment-grade corporate bond mandate, an ESG-conscious investment-grade bond mandate, and the award-winning Goodwood Milford Fund. The investment-grade bond mandate's objective is to preserve capital and provide a high rate of cash coupon over its time horizon. The objective of the ESG-conscious bond mandate is to preserve capital and generate income by investing in bonds with good relative ESG performance and attractive coupons. The Goodwood Milford Fund has provided investors with a net positive 10% compound annual return with low monthly return volatility since its inception in 2006. Since then, the fund has won multiple industry awards for Best Sharpe Ratio and Best 1, 3, 5, and 10-year annualized returns, outperforming leading alternative credit-focused and traditional balanced funds. Thanks again for joining me on the Q4 update. Please note, Goodwood provides investment commentary following each Bank of Canada and Fed interest rate announcement. Please email me if you'd like to be provided with this commentary going forward.